On April 20th, 2025, the United States imposed a staggering 145% tariff on imports from China, instantly bringing activity at U.S. ports to a grinding halt. Nearly $14 billion worth of cargo vanished from the system, leaving port terminals eerily quiet and store shelves increasingly bare. The Port of Los Angeles, usually a hive of Pacific trade, now looks like a ghost town. Retailers are scrambling to keep products in stock, while a quiet panic spreads nationwide. But this isn't just a shipping delay, it's a serious blow to the backbone of America's supply chain. Let's look at how this trade standoff unfolded and what it means for everyday Americans. The Port of Los Angeles, one of the biggest gateways for goods from Asia, has been hit especially hard. According to its executive director, Gene Soroka, cargo volumes could drop by 35% compared to last year. But this isn't just a slowdown, it's closer to a standstill. Shipping giants like Maersk and Hapag-Lloyd have pulled back, canceling voyages and rerouting ships away from the U.S. More than 80 sailings to the West Coast were canceled in April alone. And it's not just on the U.S. side. China's own ports are facing delays, causing containers to stack up like forgotten shopping carts. Some vessels are bypassing U.S. ports completely, while others are sitting idle, waiting for new instructions. This isn't like the COVID-era delays caused by health regulations. This is a policy-driven freeze, affecting cranes, customs, and trucking operations across the board. Dock workers are seeing their hours slashed. Cranes that used to move non-stop now stand still. Even ports along the Gulf and East Coast, which typically have more trade variety, are now feeling the heat, dealing with rerouted cargo, backed up customs, and reduced volumes. Dock workers are seeing their hours slashed. Cranes that used to move non-stop now stand still. Even ports along the Gulf and East Coast, which typically have more trade variety, are now feeling the heat, dealing with rerouted cargo, backed up customs, and reduced volumes. The Northwest Seaport Alliance reports a 30% drop in incoming shipments. Exporters are scrambling to retrieve containers after orders were suddenly canceled. With half of Los Angeles cargo tied to China, this isn't a ripple, it's a shockwave. What's stuck at ports is now missing from store shelves. The impact on retail is massive, and the broader economic consequences are building. Retail giants like Walmart and Target, which rely heavily on Chinese goods, are already struggling with supply chain disruptions. The National Retail Federation predicts cargo volume at U.S. ports could fall by 20% in the second half of 2025. Many stores are burning through inventory quickly. Soroka warns that most big retailers only have 5 to 7 weeks of supply left. Aisles may not be totally empty, but shoppers are already noticing fewer product choices and higher prices. Small businesses are suffering the most. Jay Foreman, CEO of toy company Basic Fun, warns that if seasonal shipments don't arrive in time, especially for the holidays, they could lose their value overnight. Inventory management has become a risky juggling act. Some retailers are trying to source from new suppliers, but changing vendors mid-season is expensive and slow. While large chains may weather the storm, smaller shops are stuck between rising costs and shrinking profits. Already, shoppers are seeing fewer choices in clothing, home goods, and electronics. But analysts agree, price hikes are coming if this standoff continues. Retailers are now rewriting their strategies, and the third quarter of 2025 could be extremely volatile. Let's zoom out. That $14 billion cargo gap and the spike in tariffs are already hitting the U.S. economy. In the first quarter of 2025, U.S. GDP shrank by 0.3%, the first contraction since 2020. It's a flashing red light that the post-pandemic economic boost is running out of steam. The transportation sector is among the worst hit. West Coast ports have slowed to a crawl. Trucking and rail freight are down sharply. Logistics companies are cutting hours, trimming fleets, and placing workers on furlough. If shipping doesn't recover soon, the pain will spread to warehouses and distribution centers, triggering more job losses. Manufacturers, especially in the auto industry, are under pressure. Rising costs for vital parts like electronics and interior components are now showing up in consumer prices, pushing up inflation for durable goods. The uncertainty around tariffs is making it worse. Businesses are holding off on expansions, freezing hiring, and cutting investments in new equipment. Confidence, which had been slowly recovering after the pandemic, is now fading again. Even if tariffs were lifted tomorrow, recovery would take months. Right now, the economy is on shaky ground, and companies are being forced to rethink how and where they get their supplies. With Chinese exports slowing to a trickle, U.S. firms are urgently looking for new supply chain partners. Southeast Asian countries like Vietnam, Thailand, and Indonesia are top picks. But it's not that simple. Vietnam's factories are already overwhelmed. Ports are backed up, and skilled labor is in short supply. Thailand is struggling with quality control issues due to a sudden rise in demand. These countries don't yet have the efficiency or production scale China built over decades. Replacing China takes time and a lot of money. Switching suppliers, ensuring legal compliance, and setting up new routes can take 1 to 2 years. In the meantime, businesses face higher costs, customs delays, and tight cargo space. Some companies in tech and automotive are considering bringing production back to the U.S. But high labor costs and government red tape make it difficult. Domestic production really only works for high-margin or automated industries. For firms that rely on just-in-time logistics, even a small delay can throw off entire production lines. While diversifying the supply chain makes businesses more resilient, it often comes at the expense of speed and cost efficiency. Yes, the shift away from China is real, but it's far from smooth. As companies scramble to adapt, the future of global trade has never been more uncertain. The U.S.-China trade relationship is stuck in limbo. Treasury Secretary Scott Bessent has admitted these tariffs aren't sustainable. Yet there's no clear path forward. China has stayed largely silent, likely waiting to see if U.S. political or corporate pressure will bring policy changes. With both sides digging in, the future of trade remains unpredictable. This prolonged gridlock has created what many economists now call structural volatility. Retailers can't plan with confidence. Manufacturers are hedging their bets, splitting investments between two costly strategies, one that assumes tariffs stay and one that prepares for their removal.